Pleasant good evening, viewers, and thank you for joining me this evening. Welcome to our fourth episode of JB's Insights and Analyses with yours truly in this weekly conversation on Guyana's development and macrofinance issues. This program is streamed live on our social media page, both Facebook and YouTube, every Tuesday evening, and rebroadcast on TVG Channel 28 every Wednesday at 8:30 p.m. I'd also like to thank our sponsors for making this program possible, Spirex Professional Services. Um, this evening, I'd like to share with you some of my perspectives on the emerging oil and gas sector, where the discussion will focus on some bit of historic context and where we are now and how we arrived at the current production sharing agreement. This discussion is intended to evolve over the coming weeks, forthcoming episodes, into a series of different thematic um, discussions on the oil and gas sector. The reason why I chose this topic and why I think it's because it's so much, it would not be enough to cover everything in one program, which is just 1 hour. Um, there are many other variables and many factors in terms of what is driving this industry, bearing in mind this is a global industry. So the reason why I have chosen to do it in this manner is because since the discovery of oil and gas, it is no doubt that Guyana has been the center of attraction globally. Right now, as we speak, Guyana is being showcased on an international stage where some of our colleagues in the private sector, as well as high level government officials forming a Guyana delegation, are participating in the annual OTC Energy Conference in Houston, Texas, a conference which I was privileged to be a part of last year. So, since the discovery in 2015, we've had many experts and analysts and economists who would have visited and who also writes on and publishes perspectives and analyses on this developments in this particular sector. And I should mention too a lot of speculation, which we will talk more about as we progress in the discussion. Now, a lot of the you know of course this program is to contribute to the national discourse and of course share my perspective and which is on the basis of analyses of data, empirical analyses and research and so on, and my interpretation of those analyses, those data and research. Now, there are a number of things that are receiving much attention in the daily national discourse. For example, there is almost a daily protest in the newspapers, a daily call by some proponents for renegotiation of the current production sharing agreement. We'll talk about that and we'll talk about the implications of doing it and not doing it, my views on that. And there are some proponents who tend to rely and in some case sometimes misrepresent the views of international commentators, international um, professionals, when they say things, they put a different spin or misrepresent what they say about a particular topic. And I'll give you examples of these as we progress in the discussion. One of the things I've seen that has been happening a lot is Guyana being compared to our oil and gas fiscal framework, or the structure of the sector, the fiscal terms and conditions in the production sharing agreement has been compared to our neighbor Suriname, Trinidad and Tobago. And there are many, many more criticisms than anyone even taking the time to pause and to look at what might be some of the positives in the production sharing agreement. Now, historically, historically, I want to give a brief historic context of oil exploration in Guyana and and other countries in the region, our neighbor Suriname, for example. And how did we arrive at the 1999 production sharing agreement with a 1% royalty? Now, oil exploration in Guyana did not start a few years ago or only in 1999. Oil exploration in Guyana began since in the 1950s. That's more than 60 years ago. And in 1999, when ExxonMobil would have obtained that contract or that agreement, they would have commenced exploration shortly after. And so at that time, if one, some of the questions that persons ask me, why, which I'm attempting to use this forum to answer, to share my perspective. Why did the 1999 contract only had 1% royalty? Well, my my answer to that is this. Imagine you are running a business or running a country or whatever it is, even a relationship. You have somebody keep coming to you with a proposal, wanting to do something, wanting to explore for oil, wanting to do this, and you know they keep exploring with and without the contract, and there has been no successes. 60 years later, no no successes, or 50 years later, no successes. And so because there were many attempts, or there were several attempts to explore, and they were unsuccessful attempts. The government at the time felt that, look, so many companies come and gone, so many people came and went, and have not been successful. That's just, and you keep pestering us, or pestering the government, and bothering them, and that could become annoying. So let's give you a contract, take this here and go and explore. It's your money anyways, it's not our money. And so I think that was the contextual background to the 1999 agreement. So hey, go, and if you succeed, well, when we reach that bridge, we'll cross it. So from 1999 to 2015, 16 years later, then Exxon struck oil in commercial quantities. Now, this is after how many years? 50 something years of exploration. 50 plus years of exploration. Finally, in 2015, we struck oil in commercial quantities. Now, of course, that was the basis of renegotiating the 1999 contract, because at that time we knew that it was, I think, in excess of 9 billion barrels that was discovered at the time. Um, we know that we have a lighter and sweeter crude, right? So what happened to the production sharing agreement? I don't want to get into all the details with the negotiating team, the competence of the negotiating team representing Guyana side, but here we are today with that production sharing agreement, wherein the the fiscal terms are Guyana gets 2% royalty plus 50% um, profit oil, right? So it's a 50-50 split between ExxonMobil and its partners and the government of Guyana. Now, what are some of the shortcomings? Some of the shortcomings that you hear, you read about almost every week in the press is the lack of ring fencing. Now, the lack of ring fencing means that if Exxon drills 10 wells, and of those 10 wells, there is a cost, of course, there is an exploration cost to, there's a cost to drill and develop these wells and to determine whether these wells have oil or not. If there is any dry well, it means the cost that they would have incurred to drill that well, which turned out to be dry, has no oil, could be recovered from another well that actually has oil in commercial quantities. Now, ring fencing tend to prevent that from happening. Now, in hindsight, when you look at all the discoveries to date, I think it's about 30 discoveries or 31 discoveries. There are only two or three dry wells, not more than three dry wells, if I'm not mistaken, right? Three out of 31 wells. Now, fortunately, that's a good thing. That is an extremely good thing. So, from the time the contract was signed, now we have moved, the sector has moved from exploration stage to development stage and now to production stage. Fortunately, that clause that one wants to argue is a shortcoming turns out to be turns out to having uh, an immaterial or not having a significant impact. I don't want to say immaterial, but not having a significant or not having a material impact on the grand scheme of things, the entire production sharing agreement. And there one has to really understand now in hindsight this production sharing agreement, what really is Guyana's stake, and why I want to delve a little deeper into this is because there was a letter in today's Stabrook News which someone shared with me and asked me to do a response and ask my views. And the author of the letter, who is someone that resides in the diaspora, writes almost every day for the contract to be negotiated. Now we're going to deal with that. I will deal with that later on, perhaps not tonight, but next week or next week. But let's talk about what he particularly wrote today and what he wrote, what the author wrote in that article today. He's saying to the Guyanese people that out of every 100 barrels of oil produced by Exxon, the government of Guyana, by extension Guyana, gets 15 barrels, while Exxon gets 85 barrels. Now, is that correct? It all comes down to interpretation. And every person, they have their own objective, they have their own agenda, they have their own modus operandi. And I can only speculate that I'm not sure what is guiding the interpretation of this author to say that Exxon is getting 85 out of every 100 barrels and Guyana gets 15, when there's several other factors to be considered. And more so, that interpretation is a very misleading interpretation, to put it mildly. Now, why am I saying this? Now, let's look at the analysis. Very, very simple mathematics, nothing sophisticated. Now, right now, Exxon is producing. Well, let's take the same 100 for simplicity. Let's take the same 100 barrels, right? Now, what is Guyana getting? Guyana is getting 2% royalty, which is not cost recoverable or ought not to be cost recoverable, and 50% profit oil. In the production sharing agreement, there is a threshold or there is a cap of 75%, wherein Exxon cannot deduct more than 75% of the gross revenue or net revenues as as cost recovery. Now, what is cost recovery? Right? Let's dwell a little bit on this cost recovery and this development cost. The development of Liza Phase 1 alone, right? Now, Exxon has a huge block called the Stabroek block. And to develop this entire block, the development cost, the projected development cost to develop the entire block is about 30 billion US. Now, 30 billion US is 7.5 times Guyana's pre-oil GDP, meaning before we started to produce oil, our GDP was just about 4 billion US. So the development cost, the projected development cost for the entire Stabroek block is about 30 billion US. Now let's talk about what has already been developed. The Stabroek block is being developed in phases. This is why you would see there is Liza 1, there is Liza 2, then there is Payara, and then as soon as one is approved, Exxon goes for approval for another license. There is Yellowtail and several others, right? That will come on stream in the near term future. The development cost for Liza Phase 1, which Exxon is producing from right now, stood at about 4.3 billion US. Now, 4.3 billion US is the entire GDP of Guyana before we started to produce oil. Now, what does that mean? To put that number $4 billion into perspective, it means that GDP, in simple terms, measures the total productive output of a country. It measures total, it's a very simple formula. GDP is equal to government spending plus household expenditure or consumption expenditure plus investments, that includes domestic and foreign investments, plus your net exports or your trade balance, the difference between your export and your import. Right? That is what GDP measures, the total output of goods and services produced in an economy. If you look at the total assets in the banking sector before oil, today it's about 300 billion Canada dollars or 1.4 billion US. Before oil, the total assets in the banking sector was about 200 billion. That's just about 1 billion US. So that means if our GDP is 4 billion, the total assets in the banking sector is just about less than 2 billion US. And the development cost for one phase one alone is 4 billion. It means if you take all the businessmen in this country, you take all the money in the bank, all the government money, all the Bank of Guyana assets, it is not enough to develop one phase. And that is why we need Exxon. And where did Exxon get its money from? Exxon was spending money since before they started to produce oil. The oil sector, there are three stages. There is exploration. Exploration could run into a number of years. For example, in this case, exploration commenced just after 1999 until 2015. Exploration is still ongoing to look to discover new fields and so on. So from 1999 to 2015, that's about 16 years. It took Exxon 16 years to discover oil. In 16 years, they were spending money. That's your plus there's the pre-contract cost. So there is exploration cost. When after successful exploration and oil is discovered, you now have development cost. You have to develop the fields, prepare the fields for production. So there is an exploration stage, hence an exploration cost. And that runs into a number of years. Then there is a development phase, developing the field, that runs into a number of years too. And during that time, cost is incurred. Then you have production costs. So that is what your development costs of 4.3 billion include, is your initial capital investment. And where did this money come from? It didn't come from the government of Guyana. It didn't come from the private sector. Guyana did not put down a cent. We did not invest a cent into developing this sector. It was Exxon and its partners who invested their capital, who invested their shareholders' money, which is equivalent to the entire GDP of this country. And therefore, in any investment, elementary finance and accounting teaches you this. Any investment, you need to recover your initial capital. And so this is what your cost recovery of 75% includes. Exxon need to recover their development costs, which they have already expended to develop the field. And from 2015 to 2019, that's about 4 years after. 4 years after they start to produce, then is when you start to bring income. So if we take from 1999 to the end of 2019, it took this industry is so capital intensive, one, and you have to be so patient. The investors in this industry have to be extremely patient to even start to reap a single dollar in return. So 20 years later is when Exxon is now producing the commodity, producing the oil that can now start to generate revenue to repay their capital investment. And after repaying a capital investment, you still need to keep the company going. So you still have operating costs. You still have to pay. You still have to pay employees. You still need to supply goods and services on the vessels, on the drill ship. There's so many other things, supply services, and so those support services are included in your operating costs. So the 75% cost recovery includes recovery of initial capital, your development costs, as well as the operating cost. Now, taking this author in Starboard News, he's saying Exxon gets $85 and Guyana gets, sorry, Exxon gets 85 barrels out of 100. Guyana gets 15. That is not correct, or that is not a correct interpretation. I call it misleading because out of that $85, Exxon has to start to recover the $4 billion that they have invested for the shareholders. Then they have to keep up, they have to incur the operating costs to keep operating, to keep the oil flowing, to keep producing the oil, the commodity, which is then sell and convert it into revenue, generate revenue. All right. So you cannot take that 85. If you want to interpret it that way, you have to look at what is Exxon profit oil, how much they get versus Guyana, versus how much Guyana gets. So what Guyana gets, we get 2% royalty. So that means out of every 100 barrels of oil produced, we get 2 barrels in royalty. And when you take out the 75% cost recovery, development, and operating cost, the profit oil that remains is 14.2. So 14 profit oil plus royalty after cost recovery, Guyana gets 14.2 barrels out of every 100, while Exxon gets 12.2 barrels. So Guyana still gets more than Exxon from a net profit standpoint or a net take standpoint. And now this is during the cost recovery period. Of course, the development cost, because there is a high cap of 75%, because of the way it is structured, um, obviously Exxon will recover their development cost very quickly. So whereas, in a typical investment, sometimes it takes 10 years or more to recover your initial capital because of that 75% cap. Exxon could recover their development cost for Liza 1, for example, in about 5 years. So, what happens after that? After you would have recovered your development cost, the only cost you have to incur now is operating cost. So, that means your profit oil goes up. And so the share of profit oil goes up, right? And because Guyana is a low cost environment on two fronts. Our crude, we're told, is a lighter and sweeter crude, right? And if one were to peruse ExxonMobil's um, annual report, you would see that their operating cost is about 30% of revenue. So if we take that same 30% as operating cost, right? Profit oil for Guyana plus royalty from every 100 barrel of oil produced will go up from 14.2 to 36.3, while Exxon will get 34.3. So again, post recovery, Guyana's stake goes up. In the current fiscal framework, the current production sharing agreement, Guyana's stake goes up in royalty and profit from 14.2 barrels out of every 100 barrels produced to 36.3 barrels out of every 100 barrels produced. And Exxon gets 34.3. Now, you cannot include your operating cost as what Exxon gets because you can't count that. You can't count the money that they take to pay their employees and to pay suppliers to keep their operations going as what Exxon gets in its pocket as profit. Right? That is why I'm saying it is an incorrect way to interpret that. Now, this is an example of the kinds of different interpretations, different views, which oftentimes sends a misleading message or an inaccurate message to the people, the viewers, and this is one of the reasons why I started this show in the first place. So that's a classic example of some of the flawed analysis and flawed interpretation of what persons put out there and write out there, which is not true. All right. Now, the other thing I want to talk about, I've made two critical points so far, which is an indirect response to some of the national discourses that are dominating our local press, our local media houses, and so on, where there is this view that Exxon is coming to exploit Guyana in a bad way. Exxon, we should we should stop producing. We should chase them out, and all these kinds of views, because every time Exxon makes a discovery, and every time Exxon produces their quarterly financial performance report, I think for the past couple of quarters they would have made about $4 billion in profit, 4 billion US profit every quarter. Some of us in Guyana gets carried away that hey, Exxon is making a lot of money. Well, what happened to us? Not considering the fact that this is a capital intensive industry. It took Exxon 20 years for them to start to produce and to generate a single revenue in Guyana. And so they need to recover. They need to be compensated for the risk they have undertaken. They need to recover their investment. They need to recover the capital employed by their shareholders, the Exxon shareholders, and get a decent return. And when you dissect the numbers, we still, as I would have just demonstrated to you, we're still getting more than Exxon. Of course, yes, um, one can argue that Exxon can be um, engaged in or involved in creative accounting and accounting gymnastics and inflating their cost and all these sort of things. But those are different matters which can be dealt with and will be dealt with differently, right? For example, the importance of the audit, which I see the vice president announced that that will soon um, commence, right? But we gotta look at it from a helicopter view, right? Is Guyana really shortchanged? The answer is no, not really. Can we get a better contract? Yes, we can. Um, Now, as I come to that point, let me dwell on the implications now. So, the government of the day has been accused of promising in its manifesto to renegotiate the production share agreement. And so there is a view by sections of society, by a few proponents, that this is a failed promise, or the government failed to deliver on this promise. But is that true? Did anyone take the time to go and read the government manifesto to see what exactly did they say, right? And what are the implications of their justification for not going to renegotiation of this current Stafford block? Now let's see. Um, let's put that to the test. So I have here on my screen the manifesto of the government of the day, and this is what was written. My comment is the government did not break any promise. What the government promised through its manifesto is to immediately work with the oil companies for better contract administration or renegotiation. So they never said that they're going to renegotiate and there is no other option. They said they will try to, they said that they will work with the oil companies for better contract administration or renegotiation. Now, what does this mean? And let's, rationalize the justification put forward of not renegotiations this particular contract. And this could be rationalized in many ways. First, let's talk about the better contract administration. The better contract administration means being able to use the same terms and conditions in the existing framework, and notwithstanding that, still being able to obtain more out of it, get more out of it nonetheless, get ExxonMobil to commit to do more things. And what are some of those, for example? I don't want to regurgitate the details, but the licenses, Liza, Liza to Payara Yellowtail, there are better terms in there in terms of insurance and flaring and a series of other things that were not in the first license that Exxon got. Right? That is an example of better administration, which translate to the more value for the country. So that's one. Secondly, we have a local content legislative framework, which also mandates, not just promotes or encourages, but legislates, mandates for there to be, to ensure maximum benefit, maximum value to the people of Guyana, to the local private sector, which is the engine of growth, which generates wealth, which creates employment, and open up a host of so many investment entrepreneurial opportunities. That is that is a second big thing which would bring tremendous value with the same terms and conditions without going to the renegotiation table, right? What is the third thing? Getting Exxon to commit more in terms of CSR programs. There is the Greater Guyana Initiative, which is a 100 million US program to that Exxon and its partners are funding to improve national competitiveness, um, to improve enhancing more foreign direct investment. Those are things that will bring more value in country to the country and ultimately the people of the country. The number four, getting Exxon to fund the gas to energy project. Now, while it is a huge cost, $1 billion, and it will be coming out of cost oil, right? We don't have $1 billion in the bank. And we are benefiting because the oil, the resources belong to Guyana. Exxon is the contractor. And so the objective is to maximize Exxon's cost oil, uh, a larger share of it, a larger percentage of cost oil should be invested in Guyana. This is what local content will bring. This is what the gas to energy project financing, the pipeline infrastructure would bring. In another session, in another program, I will do some deep dive on the cost benefit analysis of the gas to energy project. Um, as a country, the net benefit is tremendous, 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 way more than the costs and the risks to undertake such a massive project. Though, despite what some of the critics have to say about the cost and the risks and so forth, right? So there's the gas assured, there is local content. That is what better contract administration. So did the government um, backpedal on one of its promise? No, they did not. They said better contract administration, and they have done just that to maximize the value in country for its people, for the country and its people. All right. Now, the other aspect of that is what are the implications? Now, I'll talk about the implications in terms of rationalizing the production sharing agreement and why the government opted to for better administration versus renegotiation is because there are several implications. The the first implication is in this current framework there is a stability clause, and that stability clause essentially states that if the country implements afterwards any law, any legislation that would significantly change the economics of the project in Exxon's favor, then the country would have to compensate for that loss. So that's what the stability clause is about, and it's not something that is uncommon. Now, there are some debates on whether, against the backdrop of the ongoing court case where a newspaper publisher is challenging the production sharing agreement in court, there is another argument, a legal argument, which perhaps might question the constitutionality of that clause. But that's a different matter, and I do not intend to deal with that um, on this discussion, and it's outside of my expertise to deal with. But apart from that, there is a bigger implication, something big implication, or something that has a much greater ramification for us as a country. And that is, while we may not be happy with the production sharing agreement at the time when it was signed, just about a year or two after, and as I would have established earlier in the discussion, fortunately, there are just so many dry wells, a very small amount, which is not very impactful in terms of impacting significantly the bottom line. The major ramification is respect for respecting the sanctity of contracts. Now, why is that important? From an investor standpoint, is the signal that you send to other investors. Previously, in fact, when the previous regime would have won the 2015 elections, there were several agreements signed by the previous government, which is now the current government, who sought to change significantly and impose some ridiculous penalties on some companies investing in Guyana. For example, the acquisition companies that acquired some land for industrial development, the cost at which they acquired those lands, not taking into consideration the cost that those companies incur to develop those lands, and the larger development impact, the employment it would have generated, and the taxes and all of that. Right? When governments have a 5 year cycle, political cycle, governments can change every 5 years depending on their performance. When investors do business with government, when companies do business with government, when investors, local and international investors, do business with government, they need to be secure that their contract will not be overturned after 5 years, because companies, the private sector, while politicians have to think for up to 5 years, investors investing millions and hundreds of millions and billions of dollars have to do their strategic planning around a much longer cycle beyond 5 years, 15 years, 20 years, in Exxon's case, 30 years. So that is a huge risk. So respecting the sanctity of contract is important, in particular for that reason. The signal you're sending to investors, and you don't want to send the wrong signal, because if you if a government comes in and starts to relook at every single contract with companies, foreign investors, signed by another government, and start to change them in substantial ways, you will not get investment. You will not get foreign investment. You will not get even local investments. And so, how will the country grow? How will the wealth of the country grow when there is a lack of investment? And this happened during the period 2015 to 2020. Apart from activities in the oil and gas sector, there was lack of investments because for that reason. And so, for more importantly, and more reasons than one, the government of the day pulled made an extremely good decision, good business decision for the country, a good political decision, rather, not business decision. They made an extremely good political decision for the country from an investment, foreign investment standpoint, because the fact that this government would have criticized including me as well. I would have criticized the contract and its shortcomings, and have gotten in have now become government and formed the government and decided to respect it, but to get use a different approach to get more value for its people and let the contract remain. That is a very shrewd thing to do, and the politically correct thing to do from an investment standpoint. It reduces the political risk from an international investor standpoint or even domestic investor standpoint. Because you can't grow without investments, be it foreign investment, be it local investment. You can't create employment. You can't form synergies. And that is the point I want to leave with you tonight. So, to sum this up tonight, we've made several important points um, in sharing my perspective on the developments in the oil and gas sector. We've went into some bit of historic context. We've talked about the production sharing agreement. We did some bit of analysis on the royalty and profit oil, what Guyana's stake would be during post recovery, during cost recovery period. We've looked at whether if we went back to the manifesto to see whether indeed the government backpedaled on their promise, and the answer is no. They did say better contract administration. They've opted to do better contract administration, um, wherein they have they have taken some bold steps to achieve some tangible inputs or tangible results in so doing for the people and for the country, local content, better terms in the license, the insurance, and all of that, minimizing the risks. Um, so, with that, I will pause here for now and we will continue this discussion next week. Thank you once again for tuning in and joining me. And please feel free to reach out to me on our social media page, um, just to share your thoughts, share comments, ask questions, and whatever your feedback is. Please feel free to do so. So thank you, and have a good night.